Hello class, and welcome to another quick session with Professor Choi. I have decided to create this series that I'm calling Simple Steps for a Better Future. And this is designed for a lot of my students that I know are under the age of 25. And I want them to be able to not only get the knowledge that I give them in class, aka I teach economics and statistics. So I teach them a lot about economics and what it is, models like supply and demand, things like that. But I also want those students to be able to have a better future. And I know that they're watching a lot of videos online, so I figured I will make short videos, maybe less than 10 minutes long, giving them important tools for them to have for the future. Alright, so one of the things that you pick up usually in one of my classes is the understanding that recessions and expansions are cyclical. In other words, sometimes we're in expansion and everything's good in the economy, but sometimes we're in recession and things are bad in the economy. And they tend to happen regularly. As a matter of fact, some countries go through a business cycle every 4 to 5 years or so. The US normally goes through a cycle in and out, out of the cycle every 7 years to 10 years. So therefore, these cycles are not, would say, 100% predictable, but you know they're sort of coming, and therefore you can take advantage of the position or where you are on the cycle. One of the things that normally happens during a recession, which is the downturn of the cycle, is asset prices tend to decline. Now the reason asset prices decline, and when I say the word asset, by the way, in case you're not aware, I'm talking about items, things that you could buy. I'm talking about houses, I'm talking about stocks, I'm talking about bonds, I'm talking about whatever asset you can pick up, let's say a car, or maybe, I don't know, maybe a special type of vehicle that you want to buy, or anything special that you want to buy, maybe even paintings. Okay? Now the reason assets come down in price is because at some point demand decreases. If you look at US GDP, 70% of that GDP is on the consumption sector in the US economy. That basically means that most recessions are consumption driven in our economy. And every time there's a decrease in the level of consumption, there is a decline in demand in the economy. So you're going to see a decline in demand in the economy, and when that decline in demand happens, and by the way, for certain assets it may take longer than for other assets. For example, for new car sales it may happen right away, because people who lose their jobs may not want to buy that new car right away, so therefore the dealership can feel that demand decrease pretty quickly. But for houses, it may take longer, because people don't get rid of their houses on a whim. It takes a really long time for people to make a decision to buy, just like it takes a really long time for people to make a decision to sell. So house prices may take longer to change, car prices may be faster. All right? Auction prices may be faster. So, in general, when you do see that decreasing demand for those particular assets that you're interested in buying, what you're going to notice also is that those assets are going to start declining in price. And when those assets decline in price, you need to pick them up. Recessions are excellent times to buy cheap assets. But I don't want you to think of buying something because we're in recession. You need to know that in fact it is cheap. In other words, you need to know that before it used to be this price and now it is this price. And therefore you need to buy it when things are cheaper. In general, you want to buy assets at a low price and then sell them when they're high. Now, why is it that a recession is such a good time to buy? Well, because right after the recession comes the expansion. In other words, because these things are cyclical and the government is always very active trying to create that expansion after the recession, then after you see that dip in the recession, the government will do a lot of things to try to push it right back on target. Therefore, as soon as you start seeing a lot of that government intervention, or as long as you see the assets decline and then right after that the push that comes right after, you can bet that the expansion is in the future. And when you pick up the asset when they're cheap, the idea is that in the future, you're going to see that demand come back, and therefore you're going to see that asset price increase. When you see that asset price increase in the future, is when you sell it and make money. So in a very basic way, what you need to be doing is when things are cheap, you need to buy, and when things are expensive, you need to sell. Now I know that when you're in the middle of the recession, if you lost your job, it's a little difficult to follow this advice, but I need you to understand that recessions and expansions come and go. So the next time we have a really good period, in other words, every time we go into an upswing, you need to start putting money away or saving money so that when we go into the downturn, you can use that money to acquire those cheap assets. Then when you acquire those cheap assets and the system goes back to normal, you sell those assets, and that is the best way to become richer over time. In a very basic way, buy low, sell high for pretty much anything. I know it sounds like basic advice, and I know everybody thinks they know what they're doing, but I need you to understand most people don't buy the right things. Now let me keep you away from things that you should not buy. And this is where, of course, a lot of people get this stuff wrong. So people tend to confuse a lot of assets with liabilities. Let me give you an example. Okay? Let's say that you buy a piece of new clothing. So you go to the store and you buy yourself $80 jeans. Is that an asset? Yes, it is. It's jeans. You're going to wear them. Now, what is the problem with this particular asset? Well, the biggest problem is that new, it costs 80, but as soon as you put it on yourself, it becomes used. And imagine that you wear them for a day, and then right after that you want to sell them. And I'm not talking about being tricky and returning it to the store and telling them that you never wore it. I'm talking about selling it. So think about this as, real. Okay? You buy it, you have it, and then after that you want to sell it. How much is that asset worth after you bought it? Let's say it's half off. You can sell it to somebody for $40. What did you just do? You just bought an asset that depreciated immediately. This is not the kind of purchasing that I'm talking about. This is not what I'm talking about. Because these depreciate. These go down in value pretty much immediately. Therefore, this is not what I'm talking about. I'm talking about things that are valuable. And I'm talking about things that other people will be willing to pay more money for in the future. Now, I don't know exactly what you like. Maybe you like a painting from a famous painter. Maybe you like, I don't know, there was a time where baseball cards were a big deal. Maybe you like collectible cars. Maybe you like stocks. Maybe you like bonds. Maybe you like to invest in a house or a small property. There are different places where you can put your money. The point is, though, you need to buy things that go up in value at some point, not things that always go down in value. When you buy new clothing, very few of them will go back in value. Therefore, most of them will go down in value, and this is not the kind of asset that I want you to buy. Assets that lose value all the time are not investments. They are consumption. Alright? So, in any case, I hope you're listening to Professor Choi's advice. Buy low, sell high. Recessions are opportunities to buy, but you gotta have money. Expansions are opportunities to sell. If you have those expensive assets, you need to get rid of them, and then you buy them again on the next recession. Have a good one.